afternoon. This is Alecia Barnette. We're going to give it just 1 or 2 more minutes just to let everybody log on, and then we'll get started. So I appreciate your patience. Again, good afternoon. This is Alecia Barnette here at FIG, SVP in the Care Planning Division. We're going to give it just 1 more minute, and then we'll get started. I appreciate everybody's patience. All right. Good afternoon or good morning, depending on where in the country you are today. I appreciate everyone taking your time out of your busy day to join us on our long-term care webinar today. Excited to talk about some of the 4 funding opportunities in the care planning industry. Before I get started, I just want to let everybody know that all lines are on mute and in listen-only mode. So if you have any questions, make sure to type those into the questions box, and I will address those at the end of the webinar. So again, thank you so much for attending today, and please reach out to Team Barnette if you have any additional questions or they're not answered during this presentation. So let's get started here. So why care planning? Why not? 70% of your clients over the age of 65 are going to require some type of long-term care services. In fact, 1 in 5 will require 5 or more years of care. Also, it's business model protection. So if you have assets under management, for example, and your clients start taking out hundreds of thousands of dollars, what does that do to your business model? So again, business model protection, which is an important part of your business. It's good for you and it's good for your clients. Next, a long-term care event could be the biggest expense your client faces in retirement. Also, the additional revenue, it's low-hanging fruit in my opinion. I've never thought that long-term care was a great prospecting tool, but if you have an existing book of business, it doesn't cost a lot to go back to that existing book and market long-term care. So in addition to that, you get paid handsomely for it. The average case is around $200,000. And if you write 1 a month, that's over $150,000 of additional revenue. So again, a great reason to go back to your existing book of business, and it doesn't cost much at all. So what are some of the things that your clients are hearing when it comes to care? Is it won't happen to me. A lot of people expect, in fact, I do a lot of live presentations. I always ask the room to raise your hand if you think you're going to need some type of care. Typically, it's less than half the room raises their hand. So most people often think that others are at a higher risk of needing care when, in fact, the chances are great. As we just discussed, 70% of people are going to require some type of care. Our next myth or misconception that a lot of clients hear are Medicare or Medicaid have me covered. So I always ask in my presentation as well, I ask the audience, do you think the government's going to take care of you? I always get a chuckle. Medicare and Medicaid both have stipulations that go along with those. Medicare, you have to be hospitalized at least 3 days, and it covers typically up to 100 days of skilled care, and you have to be rehabilitating. It's really short-term care, not long-term care. And Medicaid, you have to spend down your hard-earned assets and basically impoverish yourself to be able to qualify. And typically, it's going to be in a nursing home. Medicaid doesn't usually pay for care in the home. So again, big misconception. Our next misconception is my family will take care of me. I say this jokingly, but does your family know that? Take my family, for example. I'm the oldest daughter, closest proximity. There are four of us and the four siblings. I have an older brother who's 10 minutes away. I have a sister who's 4.5 hours away. I have a younger brother who is about 5 hours away. My mom got sick about a year ago. She got COVID. I had to literally drive down every day, check on my mom, make sure to take her food, to take her medication, and to obviously make sure, look through that door to make sure she was okay. Because obviously I love my mother. Ask me how many times my brother, who was 10 minutes away, went. Zero. Now, I love my brother. He's not a caretaker, but he certainly is going to come over and he's going to do the heavy lifting. He's going to cut the shrubs. He's going to fix the toilet if it breaks. But he just simply isn't a caregiver. What's that going to look like when my mom actually needs care? Long-term care doesn't bring families together. It tears families apart. So just keep that in mind when you're talking to your clients. They think their plan is their family. Maybe talk to them about that and really, have them speak with their family about what their wishes are. Maybe get a written plan of care so that their families know. Last but not least, a lot of people think they're going to pay for care themselves. So the next misconception is that's what my savings are for. Most people don't understand how expensive long-term care is. So there's a great little website that I like to use. It's the Genworth Cost of Care Survey. You can actually pull up the local cost if you Google it, or you can go to longtermcare.gov, and it's going to redirect you back to this if you click on cost of care to the survey. So here in this example, I typed in Charlotte because I'm in the Charlotte, North Carolina area. And as you can see in 2021, so they're not current yet, but they're pretty close. And it shows you the local cost. So for nursing home, for example, it's $8,600 a month. For home health care, it's going to run about half of that, so $4,700 a month. And assisted living's running around $4,400 a month. So it's pretty expensive, and most people don't understand that. And in this tool, there is a little slide that you can project future costs. So here in this example that I'm showing now, there is I've projected it out to 2041, 20 years out, and now we're looking at $15,547 a month, around $8,000 for assisted living, and $8,600 for home care. So again, it's super expensive. Most people don't realize that. And if you don't have a plan, your money is your plan. So being able to discuss this with your clients is really going to open their eyes up to, wow, it's expensive. Maybe I ought to think about how I'm going to fund that plan. All right. So speaking of funding that plan, so FIG has designed a document called the Asset Identifier. So with the Asset Identifier, you're actually going to, again, use the Genworth Cost of Care Survey. And by going through that exercise, it's going to show your clients that, here's how expensive it is. My goodness, if I don't have a plan, my money is my plan. And then you're going to help your clients discover that they already have a plan in place, which is their fund. So for example, Mr. and Mrs. Jones, now that you're aware of the cost of care in this area, which asset would you liquidate first? Again, by taking them through this exercise, it helps them understand that, number one, it's expensive, but if they don't have a plan, their money is their plan. So you're going to be able to essentially show your clients how to add efficiencies to their plan. So what does the Asset Identifier look like? So here's a quick snapshot of the Asset Identifier. I like to think of it as a long-term care living will. So in your upper right-hand corner, there's a spot for company name, your address, your phone number, your email address, and then there's a place to put those local costs for home care, assisted living, and nursing home. And then there's a section to where you can actually, when you go through this exercise and they decide how they're going to pay for it, there's a place to put account name, account type, account value, and account number. And again, by going through this exercise, it actually helps them realize that their money is their plan. Then the conversation is pretty simple. Now that we have your plan, if we could add efficiencies to your plan, would you be interested? If they say yes, that's obviously a head nod for you to put a solution in place, which we're going to talk about how we do that in just a minute. If they say no, then you have your clients sign and date this form and let your clients know that you're going to be discussing this next year at their annual review. Why? Because cost of care can change, and so can their plan. So, for example, maybe they're not paying their kids' college tuition anymore. Maybe they sold a property. Maybe they got a death claim. Or maybe they're taking care of mom and dad, which is now a pain point, and they don't want their kids to go through this. So it's a great little form for that purpose, and it's going to it's a CYB form, a cover your butt form. So if 10 years from now, little Johnny and Sue comes in and says, "Hey, why didn't you offer my, mom and dad are spending all this money on care, and they didn't have a long-term care policy. Why not?" So you can pull out this form and tell little Johnny and Sue that on such and such date you discussed it, and this is their plan. This is the way that they wanted to pay for care. So again, a fantastic form to be able to open up that conversation in a product agnostic way. And then if they give you the head nod to go with the solution, there are 4 ways that you can fund these plans. So let's get into the nitty gritty here on how you fund a long-term care plan. So first of all, before I get into the 4 funding opportunities, there are really 2 primary ways to mitigate the risk when it comes to long-term care. There's traditional long-term care and asset-based long-term care. Traditional is, I like to use the analogy, renting versus owning. So traditional is the cheapest way to buy the most amount of long-term care. However, rates can go up. If you don't use it, you lose it. If you change your mind, there's no exit strategy. Whereas the asset-based long-term care products, which is what we're going to be talking about today, you have a benefit whether you live, whether you quit, or whether you die. So again, there are 4 ways to fund an asset-based long-term care plan. Highly appreciated non-qualified annuities, or one I really should throw in there as well, is 1035 exchange from a life insurance policy. Number 2, cash or cash equivalent. Number 3, qualified dollars. A lot of people have a disproportionate amount of money in IRAs and 401ks and pre-tax dollars. We can actually utilize those to pay for a plan or to fund a plan. And last but not least, income. From a cash flow perspective, this is obviously the cheapest way. You can stretch those payments out over time, anywhere typically from a 5-year pay, meaning you pay in 5 years and done, all the way to a paid age 100. So obviously, the longer you stretch those out, the less expensive the plan will be. So let's go into some hypotheticals here, and I hope that what these will do is help you kind of utilize these examples. And when you're having these discussions with your client, they're going to help you identify some of the different ways that you can fund the plan. In addition to that asset identifier, it's going to help you also find the money to pay for these solutions. So let's say, for example, we have a 70-year-old male and female. They've got an existing annuity. So for those of you that aren't familiar with the Pension Protection Act, the Pension Protection Act was signed into law in 2006, enacted in 2009, and what it allows you to do is take out money from annuity policies or life insurance contracts and not pay taxes on any of the gains if you're using it for long-term care expenses. So here in this example, if we have an existing annuity, let's say it started at 50, it grew to 150,000, just by moving it from our right pocket to our left pocket with a 1035 exchange, you're still getting your tax-free transfer, you're still getting your tax-free distribution. But if you need care, that $100,000 gain is going to come out tax-free. In addition to that, it's going to give each client around $60,000 a year tax-free income stream specifically for care. So that calculates to $5,011 a month. It's going to give them a $450,000 pool of money day one specifically for care. So again, tax-free distributions for care. Every dollar they put in, they get $3 for long-term care purposes. So pennies on the dollar leverage, tax efficiencies. And guess what? If they don't use it, they don't lose it. That $150,000 annuity, or whatever it's grown to, will go to the beneficiary, just as any other annuity would. So again, tax efficiencies, pennies on the dollar leverage. In addition to that, these long-term care annuities are going to be a little bit more friendly on the underwriting side. So they allow some concessions. So I wouldn't want to go out there and say, hey, let's put every unhealthy person into a long-term care annuity. But what I will tell you is they're a lot more liberal than the life insurance chassis. So this solution is going to be good for your highly appreciated non-qualified annuities, your older clients, because life insurance costs more the older you get, and your not so healthy clients. Those are really the three demographics for the long-term care annuity product. So if you have any questions, again, just as a reminder, type those into the chat box and we'll address those at the end of the webinar. All right, so our next example, here we have a 60-year-old couple. They have money sitting in a CD, $200,000. What we're going to do here is we're going to reposition that into a life insurance policy that's going to provide tax-free long-term care benefits. So if we're looking at that, what does that mean specifically? We're going to put it into a product that's going to provide, again, a life insurance chassis, $104,000 per person each, lifetime income stream to pay for care. Now, I put it in annual benefits, but it does pay out a monthly benefit. All of our solutions do pay out monthly. But just to show you the significance of the benefit, it pays out $104,000 per person. And that's for home care, assisted living, nursing home, etc. It is fully comprehensive like your traditional long-term care plans. Now, if both people need care, it's going to provide $208,000 lifetime income stream to pay for care. And by the way, there's only one long-term care solution on an asset-based chassis that's going to provide lifetime benefits. So it is truly your catastrophic coverage. So again, just to reiterate, $104,000 per person per year, lifetime income stream specifically for care. It would take 52% return on your money to equal or generate $104,000 for lifetime income. Probably pretty difficult to do that, right? So again, pennies on the dollar leverage and tax efficiencies. If both people need care, it's going to take 104% guaranteed return of money to equal that $208,000 of lifetime income, specifically, again, for care. Everybody wants to know, well, what happens if you don't use it? If you don't use it, you don't lose it. There is a tax-free death benefit. It is a second to die of $288,000. So live and need care, your $200,000 turns into roughly $104,000 per person lifetime income stream. If you die and don't use it, you've got a $288,000 death benefit. Now, here's the million-dollar question. What happens if you quit, if you change your mind? So in the first example I gave, it has just like every annuity, it's got a surrender value. So typically the long-term care annuities are a 9-year decreasing surrender. In the life insurance policies, depending on the solution, you can get some or all of your money back, depending on how we structure it. The less return or premium you have, the more LTC benefits you get. And in the history that I've been here at FIG, I've seen less than a handful exercise the return or premium. So why pay for it if you're not going to use it? I would always try to maximize the LTC benefit. So it's a great solution for cash sitting in the bank. This is, again, our second funding opportunity. It's good for younger, healthier clients, although I will add that these products are super liberal compared to your traditional long-term care and some of the traditional life products. So don't just assume your clients aren't eligible. Run that health scenario by Team Barnette, and we'll be able to let you know if they're an eligible candidate. And we're going to either tell you to go life or annuity, or if neither of those products work, maybe you'll go to the life insurance, your life insurance VP for a chronic illness rider, or your annuity VP for an income doubler. So a lot of solutions, but again, these are some of the most common using this funding opportunity. All right. Our next opportunity, qualified dollars. Again, a huge market. This is the fastest growing segment, in my opinion, in our book of business, because so many people have qualified dollars, and a disproportionate amount, I might add, because that's how we save, a lot of us, because maybe our employers match, or certainly we want to have those pre-tax dollars. So I'm going to say this and scream this from the back of the room, you're never going to get out of paying Uncle Sam. So just know that you're always going to have to pay taxes on qualified money. What this solution is going to do is it's going to allow us to spread out that tax liability. So this is an example of a 70-year-old male, a 71-year-old female. So this is a great RMD strategy. Now, do they need to take RMDs now? No. However, you can buy this, purchase this solution 59 and a half or older. So you can start taking them early while taxes are on sale. So how does this solution work? I like to call this the McDonald's Happy Meal. You can buy your hamburger, fries, and drink separately, but in the McDonald's Happy Meal, you're just repositioning or transferring your qualified money, whether that's an IRA, 401k, etc. You're moving that from your right pocket to your left pocket. That $200,000 immediately, day one, you're going to get a 25% bonus on your money. So in that example, you're going to get an additional $50,000. Then an income rider is turned on to fund a 10-pay life insurance policy. Again, this is why I call it a McDonald's Happy Meal. It's all encompassing. They're doing the distributions. They're paying the life premiums. It's set it and forget it for you. So what does that do for us? Again, the $25,000 that comes out each year is a taxable distribution. So for the clients that have to take RMDs, it's a great RMD strategy. For the clients that don't, why not start taking them now while taxes are on sale? And you're turning, it's kind of like a Roth conversion. You're turning those taxable dollars into tax-free money for long-term care purposes. So what does that look like? So that's going to give this couple $63,000. We'll just round here. $63,000 tax-free day one lifetime income stream to specifically pay for care, whether that's nursing home, home health care, assisted living, etc. Whether it's 5, 10, 15 plus years, that will continue to pay for as long as you live and you need assistance. If both people need care, now we're looking at $127,000 per year lifetime income stream to specifically pay for that care. Guess what? If you don't use it, you don't lose it. Now, in this example, the death benefit is $177,000. Is that more than they put into it? No, it's not. However, what happens if you pass an IRA to your kids? They're going to have to pay taxes on it, right? You're giving your kids the gift of a tax-free death benefit. So day one, you're giving them $177,129 second to die death benefit. Now, if you were to pass away before all of the money comes out of the IRA, then your death benefit's going to be higher. So in year 5, half of the distributions have already come out, but whatever's left will also pass to your beneficiaries. So you'll get that in addition to the tax-free portion of $177,000. And again, like the other solutions we just went over, they do have an exit strategy as well. So there is a cash surrender value. And again, I don't recommend doing this if your clients are wanting to, thinking about not keeping it. It's not the right product for them. But you still have a lot of flexibility. And notice on all of these solutions, you have a benefit whether you live, whether you quit, or whether you die. So again, a fantastic solution for qualified money. The McDonald's Happy Meal of all of our solutions. If someone doesn't want to transfer a big lump sum of $200,000, again, you can buy your hamburger, fries, and drink separately. You could do a 10-year period certain SPIA to fund a 10-pay. You could just take distributions out of an account and fund it every year, annual pay premium. So a lot of ways to skin that cat. Just know that you can do either. So what's next? Using income to fund a plan. As I mentioned before, you can do anything. Typically what we're going to see is anywhere from a 5-pay, meaning you pay in 5 years, you're done, all the way to a 10-pay, a 15-pay, a 20-pay, paid to age 95, and a paid to age 100. Those are the most common. We do a lot of 10-pays and a lot of paid to age 100. So those are our two most common payment methods. So here's a 62-year-old female. She's going to put in $14,172 per year. And get this, everybody, unlike traditional, these premiums are guaranteed. So they're never, ever going to go up. Might be a little bit more, but they're never going to go up. They're constant. What is that going to give her? So if she lives and needs care, it's going to give her $6,000 a month income stream for 6 years specifically for care. So again, $6,000 a month for 6 years. We're going to put 3% compound inflation on this because she's young. She might not need care for 5, 10, 15 plus years. So that's going to increase that $6,000 a month and that $72,000 a year. So theoretically, I think it's about 25 years. I'm no mathematician, but it's going to double, for example, by the time she needs the care. So now we're going to be looking at $12,000 a month. And of course, a much bigger pool of money that will last her 6 years if she needs it. Now, if she wakes up an angel and never needs any care at all, there's a $144,000 death benefit. So, I sarcastically am saying this. It's not a great death benefit. I mean, it's obviously better than a sharp stick in the eye. You're essentially somebody's going to get her money back. If you were to put $14,000 in a plain vanilla life insurance policy, it'd be a much bigger death benefit. All of these solutions are long-term care first. The life insurance is secondary. If you're looking more of a life solution or a death benefit solution, then certainly the life products are going to be a better route to go with your, for example, chronic illness riders or your true LTC riders or accelerated death benefits. So just know that there's a lot of solutions. This is just going to provide you more long-term care, less life insurance. And again, just like the other three solutions, if she changes her mind, she can get some or all of her money back, depending on when she decides to break camp and get out of the policy. So it's a great solution. Again, this is one of our most popular options. This and qualified funds are our most popular too. It's pretty even between the rest of the funding opportunities. And you can do anywhere from, again, a 5-pay to basically a lifetime pay. And the good news is, in this particular policy, if she needs care, those premiums will be waived. So just know that some of the policies out there do come with a waiver of premium. Those that don't, sometimes you can add a rider, and then others don't have the waiver of premium at all. So those are some of the things to look for in the different solutions out there. But here's the good news. We're going to do all the heavy lifting for you here at FIG. So what do I mean by that? So here are some of our care planning offerings. So again, we have the 4 funding opportunities. If you'd like some one-on-one coaching, dive a little bit deeper, maybe go through some illustrations, my team is ready and willing to do that with you. The 3-step sales process. So the asset identifier, if you want a copy of that, it's a great tool to use. Again, use it at your annual reviews. It's a great way to bring up the long-term care conversation, especially for those of you that are new in the space. It's a non-threatening way to bring up long-term care. Next, virtual point of sale support. If you're not comfortable still after we do some coaching, we can certainly jump on the call. Nick and I are licensed and happy to jump on a virtual point of sale support, a Zoom call to help you close the deal. It's also very educational for you, so you learn kind of the language and how we recommend the sales process for you. So make sure to utilize us if you're not for that virtual point of sale if you need us. Client seminars. So those of you that have been working with me, you certainly know that I travel a lot. So I am a road warrior. I love going out there and doing these client events, educational events. So if you want to utilize me, I'm happy to come to your office, to a restaurant, wherever you want to host this event, and I'll be your guest speaker. Or we can do a virtual event. So if you want to do a Zoom or a GoToWebinar, certainly we can do that as well. I will tell you we're having loads of success for these. Again, as I mentioned before, long-term care is not a prospecting tool, so I would recommend your existing book of business, again, that low-hanging fruit, because you have a relationship with them. And the long-term care conversation, you're in the business of having a difficult conversation, right? If you don't know the person, it's harder to have that intimate conversation about care, how much it costs, who in your family is going to take care of you, things like that. So just know that these are meant to be for your book of business. So if you're interested in that, reach out to Team Barnette. Social media campaigns. So if you're just getting your foot in the door with long-term care, we have some head to toe, A to Z social media campaigns we can help you implement. with some of our carriers, and we have some unique systems, and they're very educational. You don't have to do product specific, and it's plug and play. It does everything for you. So just know that we have that availability as well. So if you're interested in branding yourself as a long-term care expert or care planning expert, as we like to call it, certainly also reach out to Team Barnette and let us know. Radio shows and podcasts. I do a ton of these. So if you're interested in having me on a radio show or a podcast, myself or Nick, we're happy to do that for you as well. And that we've got some great kind of plug and play content for you, so you don't have to dream up questions, and you just need to show up, and we need to show up. So if, utilize us if you'd like to have us on your show. So how do you get in touch with us? We have a website. It's teambarnette.figmarketing.com. There are a lot of tools on our website, a lot of downloads. So that, for example, the asset identifier, we do have that located on the website. We have a long-term care pre-qualifying tool. So if you want to get some health history for your clients, there's a document there that will help you do that and send to us so we can do that heavy lifting. There's copies of webinars that I've done. In fact, I'm going to add this webinar. So if you wanted to watch it again, it's going to be located and housed on the Team Barnette website. And if you're interested in any of the offerings that I just discussed, you can email the team. So we have this email box. It's careplanning@figmarketing.com. So careplanning@figmarketing.com. That goes to the entire team. That's even a great place to send quote requests. That way, if I'm out, again, I'm a road warrior, so I'm not in the office a ton. So that enables my other teammates to pick up those quote requests or marketing requests or whatever that request may be. So I definitely recommend doing that. If you want to speak to me, feel free to give me a call. So my number is 704-439-2362. So that's all for today. I'm going to look and see if we have any questions, but certainly long-term care or care planning, again, as we like to call it, is a very, very important part of somebody's financial plan. It's the biggest mistake that your clients make in retirement. We want to help you implement care planning into your practice. So please reach out to us if you're not sure where to start, and we're happy to help you. I see one question, and that was, will the slides be available after the presentation? I am absolutely happy to send you those, so that's no problem at all. I'm looking to see if we have any additional questions here. I'm going to just leave it open for 30 seconds or so just to see if anybody's going to add anything. But certainly, again, I appreciate everyone's time, and we will certainly reach out to you with any, if you have any questions. I see one now. Can you mass email? So we do have some email campaigns. So if you're interested in email campaigns, just shoot an email over to careplanning@figmarketing.com, and we can discuss with you where you can find some of these mailers so that you can market to your existing book. Or if you want to market to the public, you can. I will tell you the results aren't going to be quite as good as if you go with your own book of business. Let's see here. Okay, so if there's anything that I haven't addressed, again, I see there's a couple questions I'm going to answer offline. They're specific, so I don't see any general questions. But I, again, certainly appreciate your time. And again, we'd love to help you implement care planning into your practice. Thank you, everybody, and have a fantastic day.